Markets are efficient, yet patterns hide in plain sight. The weak-form efficient market hypothesis says past prices don't predict future returns, but nonlinear dependencies like volatility clustering persist. We'll use information theory to measure these signals and see why AI models often fail to profit from them. The weak-form efficient market hypothesis states that past returns cannot predict future returns. This implies that linear autocorrelation is zero. But that doesn't mean returns are completely random. Nonlinear dependencies, like volatility clustering, can exist without contradicting efficiency. This is the paradox: markets can be efficient in the linear sense, yet still exhibit complex patterns. To quantify uncertainty in return series, we use entropy rate. It measures the average information per observation. If the entropy rate is positive, the series is unpredictable in the long run, but it can still have conditional predictability. This sets the stage for understanding how much information is truly available. The weak form EMH is mathematically expressed as the conditional expectation of returns given past returns being zero. This means the best linear predictor is just the mean. However, the conditional variance can be non-trivial, leading to volatility clustering. This is a key insight: efficiency restricts the mean, not the variance. Mutual information captures both linear and nonlinear dependencies between returns. It's the reduction in uncertainty about today's return given yesterday's. If mutual information is zero, returns are independent. If positive, some dependency exists, but it might be too weak to exploit. Volatility clustering is the tendency for large price changes to be followed by large changes, and small by small. This is a nonlinear dependency that persists even in efficient markets. Garch models capture this. The VIX, currently at 14.97, reflects low expected volatility, but clustering still occurs. This pattern is real but not directly exploitable for returns. Linear dependence is what autocorrelation measures. Nonlinear dependence includes volatility clustering and other complex patterns. The weak form EMH only rules out linear dependence. So, nonlinear patterns can exist without violating efficiency. This distinction is crucial for understanding what AI models can and cannot capture. AI models try to capture these nonlinear dependencies. But the signal-to-noise ratio is extremely low. For example, an LSTM predicting daily returns typically achieves an R-squared of less than 1%. This means the model explains less than 1% of the variance. The rest is noise. So, even if a pattern exists, it's too weak to be economically significant. With such weak signals, overfitting is a major risk. Models can easily fit noise, mistaking random patterns for real signals. This is why many deep learning predictions fail out of sample. The more complex the model, the higher the risk of overfitting. The key is to validate models on unseen data and focus on economic significance, not just statistical significance. Let's look at the VIX as a real-world example. The VIX measures expected volatility. As of August 17, 2026, it's at 14.97, down 20.3% over the past month. This indicates low market fear. But even in low volatility, clustering can occur. This table shows the recent VIX trends, illustrating the current low volatility environment. For traders, this means that simple linear strategies based on past prices are unlikely to work. But volatility forecasting can be valuable for risk management. AI models might have an edge in predicting volatility, not returns. However, the edge is small and requires careful implementation. The takeaway is to focus on risk, not just return prediction. In summary, the weak form efficient market hypothesis does not rule out nonlinear patterns. Entropy and mutual information help quantify these patterns, but their economic significance is minimal. The VIX's recent decline to 14.97 reflects low volatility, yet clustering persists. AI models face an uphill battle against noise, and overfitting is a constant threat. The prudent approach is to focus on risk management and volatility forecasting, not on predicting returns. Markets are efficient in the sense that exploitable patterns are rare and fleeting. As always, do your own research and stay cautious. We'd love to hear your thoughts. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.